Welcome to Energy Unplugged, the go-to podcast focusing on the global energy transition. My name is Christina Rentell, and I'm Aurora's research lead for France and Iberia. Today, I'm delighted to be joined by Marion Calcine. Marion is Chief Investment Officer at Ardian Infrastructure and member of the Ardian France Executive Board. As CIO, she supervises investment processes for Ardian infrastructure funds in Europe and in the Americas. She's participated in a number of transactions on behalf of Ardians, car parks, motorways, airports, and, of course, renewable assets. She is or was on the board of various Ardian investment companies, and she also co-leads the digital project Opta, which aims at optimizing operational performance and minimizing the merchant risk of a 2-gigawatt portfolio. Welcome, Marion.
Thank you, Christina. Hello. And hello to the listeners of this podcast. Thank you also to Aurora for having invited me here today.
So before we get into Ardian's investments, could you maybe just share a little bit about how you became the CIO of Ardian and investing in infrastructure?
Yes, sure. By background, I'm a statistician and an actuary. When I joined the team, and that was a long time ago in 2006, I started with a very traditional career path as a financial analyst. So as you said, I participated to many of the transactions in the portfolio because I was the first analyst. So I was the only one there to build the financial models. And so I worked on airports, on car parks, on motorways, on energy, utilities, renewables. And in 2017, when we started investing not only in Europe, but also in the US, we thought that it would be very important to ensure consistency of our investment approach across the various funds that we were managing. Today, we manage $36 billion of capital in infrastructure direct investments. And so since 2020, I supervise the investment processes for all our direct investments. I try to provide portfolio construction views as well as first-level risk management. And this is important to our investors because this way, they have the comfort that if they put €1 in Europe in our European fund, €1 in our renewable energy fund, and the same amount in the US fund, they have an investment approach from their GP, which is fully consistent across the funds in which we invest.
Perfect. I also started as a financial analyst, so we're off to a good start here. Mentioned in the intro, and you just touched on it there, you invest in a lot of different areas. What are the specific areas of investment that Ardian focus on, and also maybe a bit more specifically in terms of country and geographies?
Sure. Our main funds in infrastructure are closed-ended funds. So we have one European flagship fund and one US mid-market fund. They both invest in 3 sectors, which are digital infrastructure, transportation, and energy utilities. They invest predominantly in OECD countries, and we try to balance the diversification of our portfolios across sectors, but also across the countries in which we invest. Importantly, at Ardian, we invest locally. Is one of the leaders in private investment. It's a private investment independent house, which has $177 billion under management. It's a company which operates from 19 offices all over the globe. And so we have employees, team members, which are based in the countries in which we invest. And that is extremely important. So we try to diversify our portfolios through sectors and geographies, and we invest wherever we are located.
Yeah, it's definitely important, especially with those specific sectors, to make sure you're close to what's happening on the ground. I think that's something that Aurora's seen as well.
Absolutely. When you invest in strategic infrastructure investments, you need to be close to the local market environment. Basically, banks, industrials, institutions, governments, you really need to be into this ecosystem.
Mm-hmm. Yeah, definitely. And thinking about the investment, so as I understand, they're usually fairly long-term investments, right? How do you deal with the short-term volatility that we've seen maybe on the market, especially thinking about energy? We've seen negative prices coming across Europe. We've seen high gas prices, even if you go further back to the COVID crisis, low demand growth potentially. How do you deal with these short-term kind of volatility in a long-term investing environment?
It's a very good and it's a very broad question. Yes. It's true that the market today is changing and is very volatile. And I would mention four aspects in this new market and geopolitical environment, which are very relevant to our investments. First of all, the supply and the price of gas is not easy to predict any longer, and that's particularly the case in Europe. Second, we have seen great renewable rollout, but that creates intermittency, periods of very high prices, periods of very low prices, overall volatility, in short. Third, the demand of energy is more difficult to predict. There is greater efficiency in all the usages that we know on the one hand, but there is also larger energy demand, notably from the data centers on the other hand. And finally, what is also new is that decarbonization objectives are becoming less clear in many regions in the world. And so I would answer first on our infrastructure investments in general, because as you mentioned, we are not only renewable investors, we are investors in infrastructure investments. So for non-energy investments, say roads, data centers, energy is an input, it's a cost. Apart from data centers, our assets overall are not big consumers of energy. And so what has been very important in this volatile market environment over the last few years has been to secure the long-term supply of energy for these assets, including the data centers, and the cost pass-through of these energy costs to the clients. And that has also been the case for our data centers, notably, because it's a very big cost item in data centers. And we only have energy contracts which are passed through to the big clients that we have. So that's for I would say, the approach to monitor the risk of energy supply and price volatility for infrastructure investments.
And maybe just a follow-up question on the data centers, because I do think that is obviously something that's, been up a lot over the last maybe couple of years. And there's this need to have the baseload power, as you said, and have this long-term energy supplied. Have you found it easy to get contracts that comply with that, need for 24/7 energy in terms of the data centers?
It's a good question. I think the data center platform in which we invested, which is called Verne Data Centers, is active in the Nordic countries as well as in the UK. So it has presence in Iceland, Finland, and in the UK. What we were extremely cautious about during the due diligence was to make sure that we would not assume data center capacity development in places where there would be a lack of energy supply. And so we cut in our BP projections that the sellers had put forward, wherever we thought that it would be very difficult to ensure grid connection or PPA. And that's the approach that we have when we build business plans for data centers. You need to make sure that the short-term, long-term, medium-term capacity that you are assuming in your business plan is palatable with the energy supply in a given country, in a given region, and at a given connection point.
Yeah, definitely. And I think those are the two things that we're seeing as well, the availability of the grid connection for demand in certain countries, even in countries where there may be a more liquid PPA market, is limiting potentially the development of data centers there.
Mm-hmm. Absolutely.
Perfect. Maybe now moving on to the renewable energy investments then. So specifically thinking about price volatility, what is the approach to risk management there at Ardian? How do you manage that short-term volatility there?
First of all, we are a big investor in renewables. If you sum up all of our funds, we have directly and indirectly ownership over 8 gigawatts of renewable energy in 10 countries. Apart from our flagship infrastructure closed-ended funds, we notably manage an evergreen open-ended fund, which is dedicated to renewable investments. This fund invests predominantly in Europe and in Latin America. Our approach to investment strategy in renewable sector in a volatile market has several components. First of all, we tend to focus on mature technologies, wind, solar, hydro. We try to make sure that the investments which we do have a pretty high share of contracted or regulated cash flows. We aim at building diversified portfolios with a high share of revenues coming from regulatory schemes such as feed-in tariffs, CFDs, or private contracts, PPAs, which give visibility over the long-term cash flow generation. Then we try to diversify across geographies and technologies. The merchant exposure of our renewable portfolios is well mitigated by the diversification strategy that we pursue across technologies. We have onshore wind, solar, hydro, battery storage, and we have exposure to different price zones. So, for instance, in Europe, we have exposure to Nordics, to Spain, to Italy, to France. So different price zones, different pricing dynamics. Then I would say we try as much as possible within our renewable investments to build stable loads. We were one of the first managers in Spain to build hybridized plants. So combining solar and wind assets at the same grid connection point, or to co-locate batteries, notably on solar assets. This can substantially improve the performance, and it helps mitigating adverse market conditions, such as the negative prices you were referencing at the beginning. And finally, and most importantly, I would say, is the long-term view that you put in your investments. Our conviction is that the energy mix will keep evolving towards a growing share of renewables, and this will be coupled with flexibility solutions, whether they be battery storage, demand response, gas peakers. This is the only way to generate local and cheap energy, even regardless of the decarbonization objectives. And this is very important for Europe today. So to ensure sustainable development of new renewable capacities, the market remuneration over the long term should cover the LCOE of renewable technologies. Hence, even if there is a short-term volatility, it's important to have a long-term view on what is the winning technology by country and what will be the LCOE of the new build for this technology in that specific country. And this is really what drives the value of your renewable investment. This is also the most important variable, so to say, in your business plan.
Mm-hmm. Yeah, definitely. And as Aurora is in the long-term modeling forecast, completely agree. I have
Yes.
to say, we promise we didn't make you say that. Maybe just a follow-up question on battery storage, because I think what we're starting to see now is more financing of battery storage, especially in those countries where maybe, that wasn't the case a year ago. And we're starting to see, a big capacity coming through. One of the things we're looking into currently is how can you mitigate the merchant risk of a battery? Do you have a specific strategy on how attractive the merchant revenues there, or are you still looking for contracted revenues on the battery as well?
It's a very good question, because battery storage, thanks to the decreasing cost of the technology, is progressively imposing itself as a credible alternative to gas in terms of providing flexibility. And in some countries, I'm thinking of Spain, for instance, solar plus battery can be cheaper than gas. And so this is an investment that we want to be able to do. And this is an investment that is crucial for energy independence. Having said that, as you mentioned, this is in most cases a merchant investment still. So there are countries in which there is capacity remuneration, but in most cases you have to take merchant risk, whether you use the batteries for peak shaving or to bid on the ancillary services markets. So the approach that we've had so far is that whenever this is a merchant investment, we try to minimize the upfront investment. We don't necessarily need a proper offtake, but what we are building is battery storage, which is integrated into a wider portfolio of production. We made an investment in battery storage in Finland, where we have operating wind assets, for instance. If we were to think about large-scale battery investment, I would say without an existing production capacity, then it becomes a standalone investment, and it's not an investment to provide baseload production, basically. It's really a standalone investment in flexibility. And in order for us to write very big checks in that sector, I would say we would need downside protection. For instance, a utility which would give you an offtake over the long term with, I would say, a minimum floor, and then upside sharing to align interests. But I would not imagine ourselves making very big checks for pure merchant assets in that sector.
Yeah, definitely. And it probably has an impact on the potential financing and the leverage that you'll be able to get on those assets as well in the case that that's required.
And the risk itself, yes.
Yeah, definitely. Okay, perfect. So maybe moving on to, we've discussed batteries a little bit, which maybe you can't be considered such a new technology anymore, but thinking about, investments in new technologies. So I'm thinking here maybe on the hydrogen front or even smart grids. How does Ardian think about incorporating those types of assets into its portfolios or funds?
Batteries, we discussed a little bit. I mentioned the Finnish assets, but we have been earlier investor in batteries. We made our first investment in the space in Canada back in 2020 in partnership with NLX. This was supported by a specific regulatory scheme aimed at incentivizing peak shaving. Then we did this Finnish battery investment, which is mostly relying on the stack of ancillary services to the grid. Beyond this and leveraging on our digital capabilities, we are actively assessing battery collocation opportunities in all the portfolios in which we have production, and in order to optimize the capture price of our renewable assets. And this is something that we are also pursuing on a decentralized level with Green Yellow, which is our distributed solar platform in France. Hydrogen is a sector in which Ardian indirectly invests through its joint venture called Hy24, who raised the largest hydrogen infrastructure fund 3 years ago, €2 billion fund supported by industrials as well as financial players. Hydrogen should play a very strong role in the energy mix in the long term, and it's a complementary way to store energy and to solve the intermittent nature of renewables, really.
Yeah, absolutely. Just thinking on hydrogen, for example. So we've seen, Ardian's been investing in hydrogen for a while, as you mentioned. When some of those technologies become maybe a little bit less favorable in the public eye, let's say. So we've seen hydrogen, some questions come out of hydrogen investments over the last year or so. Again, linking back to the kind of short-term volatility and long-term investing, how convinced are you that hydrogen will still be important going forward in the renewable sector?
It's true that the hydrogen market is undergoing headwinds as we speak. This is mainly linked to the climate agenda becoming more secondary in many countries, and also to the high level of interest rates. It's much more expensive today for utilities and for all majors to finance early stage investments in the hydrogen sector. So they arbitrate in favor of other investments. On top of that, the hydrogen value chain, from production to transportation to distribution, even to consumption, needs to be supported by much more structuring, many more subsidies across the value chain. And it's not easily done when the climate agenda becomes secondary. We are at Ardian, at Hy24 as well, of course, we are and we remain strongly convinced that hydrogen is the only answer to decarbonize certain industrial processes and heavy-duty transportation over the long term. Hy24, over the past few years, has made significant investments in the upstream segment. For instance, it invested in Stegra, which is the largest green steel producer in Sweden. And this is an investment which is currently under construction. But Hy24 also took participations in downstream, investing in service stations, for instance, or in hydrogen vehicles fleet. In this market, which currently has been slowing down, Being one of the biggest funds with dry powder available is not the worst position to be in, I would say. We have seen in the past excessive valuations for hydrogen developers, and now these valuations are coming back to more reasonable levels. So we can structure deals in a more efficient way, in a more protective way from a risk management perspective. We are not evolving anymore in a seller's market where you need to pay development premiums even before the investment gets ready to build. In terms of strategy, the current environment in hydrogen pushes investors to put smaller tickets in a greater number of deals because few of them are currently getting authorized and reach ready-to-build status. And so in the current environment, we are able to structure more transactions, paying development premiums at completion stage rather than earlier. So in short, it's a more challenging market, but it's probably prone to offer also very good investment opportunities.
Yeah, I completely agree. It's about finding those sectors where green hydrogen really is the answer and maybe not forcing it into others as maybe we were thinking previously.
Exactly.
Excellent. So now we mentioned in the introduction the Opta platform that you've been involved with. So basically, what is the Opta platform and how has this helped transform the infrastructure management and decision-making process at Ardian?
Opta is a project that we launched back in 2020. Actually, when COVID locked us at home and when making investment decisions became less easy, I would say, we decided with Pauline Thompson, our head of data science at Ardian, to spend time developing Opta. Opta is a software which relies partly on available solutions on the market and also on parts which we build internally at Ardian, our data science and our IT teams all together. First, Opta aims at improving the operational performance of our renewable assets so that they become more predictable and more stable. And second, Opta monitors the market risk to which our renewables are exposed. And this helps us build diversified portfolios to control the risk, the merchant risk we are exposed to, but also the benefit and the upside we can take from the merchant exposure. Through Opta, we gather 800 signals every 10 minutes for a fleet of 3 gigawatts of renewables in 10 countries. So that's massive. We analyze this data, we try to make sense out of it at single asset level, of course, but also at portfolio level. And this is game changing in the way we approach asset management. We analyze the data at portfolio level. For instance, our CEO in Italy will see the data which is related to his 500 megawatt fleet. Our CEO in the US will see the data which is related to his 1 gigawatt fleet. At Ardian, we see the data which is related to the 3 gigawatt fleet. The 3 gigawatts is really the fleet that we directly control. So we are majority owner or 100% owner. On this fleet, we can observe the irregularities, the issues, the ways of improving at portfolio level rather than at asset level. And if we see something irregular on a turbine in Italy, and we know that we have the same turbine in the US, we will mention this to our CEO in the US for him to keep that under scrutiny. Using Opta has really provided results to enhance the performance of our assets. Thanks to the active monitoring of our fleet, reacting swiftly when something goes wrong, our assets were available, ready to produce electricity over 1 more week per year than before we were using Opta. You can think 1 more week is a low number of days, but as the resource is free, the wind is free, this is a direct increase in the cash flows for the assets. The second aspect of Opta is to provide support in risk management and analysis of our new investment opportunities. Many renewable investors and people who listen to your podcast are used to P10, P90 of wind production. P90 is the level of production an asset is supposed to achieve with a 90% probability. So there are 90% chances that the wind production will not be below such level. With Opta, we calculate the P90 of revenues, taking into account the famous P90 of wind production, but also projections of prices and the correlation between the two. And of course, there is correlation between the two, because in a country where there is a lot of wind production, when there is a lot of wind, production is high, and so the prices get low, even negative. And so when you are able to calculate the P90 of revenues, you are also able to test what is the minimum level of revenue you can get if you add to a given portfolio a different technology. For instance, if I add a battery asset to solar asset, what are the minimum revenues I can expect, and with which volatility? And that's very, very interesting. It's the same for price zones. If I have exposure to Nordic countries, what happens to my P90 of revenues and to the volatility of my revenues if I add exposure to Spain, for instance? And so overall, these quantitative tools, and this is the statistician speaking now, these quantitative tools, which are not very usual in private investment, I have to say, they become hugely useful for investment decisions. And this is how portfolio construction is no longer a concept, right? It's a quantified reality. And so this is really what we aim at building with Opta.
And that sounds really relevant as well when you start to look at the hybridization of assets as well, not just on a site, but across the portfolio as well. We're used to maybe looking at the single asset, how much is a solar P90 on revenues and production. And obviously that changes a lot as soon as you start adding additional technologies.
Absolutely, because the objective at the end of the day is to produce 24 hours a day, to be able to serve customers, which are people at home as well as big industrials.
Yeah, definitely. So we are nearing the end of the podcast now. So as a final question, and looking ahead as long term as you would like, what are some of the emerging trends or sectors within renewable energy, or the more global energy transition maybe, that you see emerging over the next few years?
Difficult and interesting question. First of all, I am convinced that renewable capacity build out will continue and will even accelerate over the next decade, because if you think about it, this is the only sustainable way for Europe to articulate energy independence and cost competitiveness, even putting aside decarbonization objectives, while I hope that decarbonization objectives will become again high on the agenda. With the rising share of intermittent renewable energy in the mix, the capture discounts of renewable technologies will keep increasing. And so in such market, the winners will be the operators who have managed to reach scale and high level of diversification to be in a position to offer baseload PPA without incurring disproportionate risk. And this is one of the key objectives we are preparing for, notably through Opta, but notably as well through the investments that we are doing in different regions, different technologies, notably through our renewable fund. In a word, scale, diversification will be the keys, in my view, of tomorrow's renewable space.
Definitely. Coming full circle with supply and demand, I think is one of the key challenges. Well, great, Marion. Thank you so much for joining us today. It's been a real pleasure and very insightful.
Thank you, Christina, and thank you to all the Aurora team for having me today.
That was Christina Rentell, Aurora's research lead for France and Iberia, talking to Marion Calcine, Chief Investment Officer at Ardian Infrastructure. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow or subscribe to the podcast via whatever platform you use.